Matthew Bell with insuranceprescription.com, and today I wanted to pick up where I left off in a previous video where I described 5 mental mistakes that you can make in terms of your thinking about credit cards. In this video, I wanted to add to those and give you an additional 5 mistakes that people can make financially, from a financial point of view, irrespective of their mentality. Now, I'm not saying mentality has no role to play, only that these mistakes, in a sense, are more easily quantifiable. So you can actually take a number on this. So, for example, in the other video, one of the mistakes was thinking about credit as free money. And there's no way to really quantify that. But in this video, mistake number 1 is overcharging, racking up a huge amount of debt. Now, granted, there's going to be a difference of how much a huge amount of debt is going to be for you, would maybe be different from how much a huge amount of debt would be for me, or a huge amount of debt would be for some other person. But in principle, we can actually quantify how much debt a person has. We can relate it to their income and other expenses, and in virtue of doing those calculations, which it would be beyond me to get into that in the present video, but in virtue of doing those calculations, you can get a kind of a rough idea of people who are charging too much. Kind of the worst case scenario in that instance would be maxing out the credit card. That is to say, you rack up such a large amount of debt that you literally have zero open credit because you have taken every available dollar of credit that you have and charged it. Now, the second mistake that you could make in terms of actual financial mistake with respect to the credit card is making payments late, so not making payments on time or missing payments entirely. So this will really hurt you in terms of your credit score, obviously, and it's going to then cause late charges to be assessed, possibly other penalties. In some cases, your annual percentage rate is predicated and depends upon you maintaining a certain payment history and a certain credit score. And if you begin missing payments, not only are you going to owe the payment, plus interest, plus possible penalties and other fees, but you may also find that your annual percentage rate gets reset to something higher, and then things just really start to snowball. The third mistake is somewhat related to it, and that would be making payments, but making only the minimum payment. So in other words, not paying your balance off in full or stretching your payment interval over too long a period of time. And the reason this is a mistake is because the interest is going to start eating you alive. So obviously, if you only make the minimum payment, you are not paying the debt off in full. And so what is going to happen in that case is whatever unpaid balance you still retain is going to continue to accrue interest as you move along. And that debt that you owe is just going to get bigger and bigger, even if you're not further charging items on that card. So in a similar way, carrying a balance forward is just another way of phrasing this. If you're carrying a balance on the card, it means you're not paying the card off in full every month. Now, there are a few ways of using a card. Some people rely on a card as an emergency fund. This is not the place to get into that or to critique it here, but suffice it to say that many people who are more savvy than I am financially recommend that the proper way to use a credit card is to never purchase more than you can afford to pay in cash. And then the real benefit of using the credit card is that you are able then to, number one, isolate the payment from your funds. I recently had fraudulent activity on my account, and the recommendation that I was given was make sure you're not using your bank card or your debit card, because that's your money. That if there is a fraudulent activity on the credit card, that's at least not your money that's being taken out. But at the same time, you can also sometimes qualify for various rewards or points. So if you make a $100 purchase out of your bank account, you're going to pay $100 for that. But if you make a $100 purchase on a credit card that, let's say, pays you back 1%, then your purchase is actually going to be $99 because you'll get $1 back. The proper way to use a credit card in many people's minds is to try and take advantage of some of these promotional offers, some of these perks, and some of these point systems to get a discount, basically, not to spend money you don't have or to carry a balance forward that's then racking up interest charges. A further mistake is opening and closing accounts incorrectly. So this is going to piggyback on some of the other ones, but in terms of opening credit cards, again, the wrong way of thinking about opening credit cards, the wrong way to actually open credit cards would be because you have maxed one out and you need to have more credit. Now, if you've maxed various credit cards out, the likelihood that you're going to be able to open a new line of credit goes down, or at least that you're going to be able to open a line of credit with a low or favorable interest rate. There are almost always people who are willing to lend you money, but once you start to get into financial difficulty and you start maxing out one card and a second card, oftentimes what you'll find is the only loans or credit cards that you are able to get are going to be ones that charge a very, very high interest rate. So you don't want to think of it as free money, you don't want to max it out, and you don't want to make the solution to maxing your card out opening another one that you're then also going to max out. The solution would be credit counseling, possibly debt consolidation, debt settlement. These are going to be topics for other videos. I have actually already gotten into debt settlement in one video, and you can check out that. Put the link in the description. But you can also make an error with respect to closing credit cards. Now here there's a couple of different schools of thinking. Some people are going to say close the accounts that you do not use, that you don't need, and other people are going to say you should at least continue to charge minimal purchases and then pay them off on every card that you have. And the idea there is to help to try and improve your credit utilization score. So credit utilization is essentially the percent or the ratio of debt to open credit that you have. So if you have a favorable utilization, then some sources indicate you're going to have less than 30% of your available credit actually charged in debt. So if you have a $10,000 credit limit, then roughly $3,000 on this view would be your maximum you'd want to charge in order not to go into an unfavorable credit utilization territory. Now, having said that, we've already said that you should only aim to purchase things with the credit card that you have money to pay for in cash. So if you're paying the card off in cash every month, you're paying for it in full. I'm not so sure how big of an impact this credit utilization number is, but if you routinely are overcharging and racking up debt, not only is it going to hurt you with respect to the financial point of view where you're getting hit with interest charges, but then your credit score is also going to tend to meander downward because the credit card companies are going to see that you have an unfavorable credit utilization. So in some cases, people recommend keeping cards open that you don't use because let's say you have two credit cards, each with $10,000. Even if you have a $6,000 balance on one card, it's still a 30% utilization because you have to factor in the total open credit, and now you have 20,000 instead of 10. But you have to be disciplined. Discipline is probably the key to a good credit score and a key to proper use of credit cards. Certainly. The fifth financial mistake that you can make is not attending or paying attention to the interest rates that you're being charged. So some people focus a lot on rewards and points, and they're kind of up on this, but they may neglect to factor in the actual interest rate that they're charged. A related topic here would be not understanding or doing credit card hacking correctly, so you can put yourself in a detrimental position if you don't really understand the process. That's not going to be something I'm going to get into in this video, but suffice it to say that when you're thinking of credit cards, obviously one of the major concerns that you should have is what is the interest rate, what is the actual annual percentage rate that I'm going to be having to pay. Department store cards are sometimes just astronomical in terms of the interest rates that they charge. It can be 20 to 30%. If you find credit cards that are only given to people who have a poor lending or credit history, then again, their credit card interest rates might go even beyond that. So you want to pay attention to the interest rate because obviously that is the thing that is tacking on additional amount of money onto purchases that you make. I am no expert. I am not a financial advisor. I am not a credit counselor. The only thing I can say is that I have made many of these mistakes myself, and so in trying to inoculate maybe my kids against having to go through the same thing that I did, I try and present this information. If you found something of use, please like the video, subscribe to the channel, click the notification bell to be alerted to new content as it becomes available. I thank you so much for being with me today, and I invite you to join me again for another video. Thank you.